The president came out a short time ago and said the Fed should lower interest rates. When he talks, do you listen?
Well, we hear lots of voices. I would say my job is really to talk within the 6th District and see where policy should go based on what I'm hearing in terms of the momentum of the economy. And today, what I would say is there's a lot of uncertainty. Forecasting is maybe a bit more challenging than it's been in the past. But look, I stay on my job to just talk to the business folks that we see and hear from them to understand sort of what's happening on the ground. And that really is the thing that informs me very much.
Well, this is the part where I'm normally going to try to pry out of you some sort of guidance on future interest rate moves. But when you look at the summary of economic projections, the dot plot from last week, one gets the impression that you don't really have a clue at this point.
Well, you know, what we've heard and what I've heard is that we don't really know where the economy is going to go. Business leaders don't know, families don't know, and local policymakers don't know either. So one of the things that really has impressed upon me is the idea that people are taking on board information as it occurs. What they're hearing are things that are leading to expectations that there'll be upward pressure on prices, so that inflation will happen longer. And I've taken that on board. So my projection of where inflation is going to go this year is pretty much sideways. And we won't get back to a more neutral level of inflation, our 2% target, I don't project until sometime early in 2027. But it is very much hearing people, take in the latest news, figure out what that means for them, and then I will respond to that in terms of how I think about the economy's trajectory and policy.
Last month you said you thought that we would have 2 rate cuts this year. The dot plot didn't change, still calling for 2 rate cuts, but a number of people moved their dots up to say maybe we get fewer than that. Were you one of those?
I was one of those. So I was at 2. I moved to 1, mainly because I think we're going to see inflation be very bumpy and not move dramatically and in a clear way to the 2% target. Because that's being pushed back, you know, I think the appropriate path for policy is also going to have to be pushed back in getting us to that neutral level.
Well, some of your colleagues also moved their dots down, suggesting that we might see more rate cuts, probably because they think the economy will weaken. What do you think the odds of an economy weakening because of fiscal policies are?
Well, what I would say is I am hearing more concerns about the trajectory of the economy. That's undoubted. But what I also will say is the data that's come in to date has not actually shown that, and we've still seen a resilient economy. I do know that consumer sentiment has started to take a dip, and the question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy, that as how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Well, it's hard to know for sure what consumers are going to do, but you talk to business leaders all the time. What's the general attitude of CEOs right now about business outlook and about their plans for, say, hiring or even raising prices?
So, you know, we actually have started to ask our business leaders exactly this question. Where do you think pricing pressures are going to go, higher or lower? What we've heard consistently is they think they're going to go higher. Then we ask, what do they think is going to happen in terms of their sales? And they're also quite bullish on the sales rising as well, which says to me they think that consumers are going to be able to manage these higher levels of prices and whatever changes in prices that happen moving forward. We'll have to see if that actually plays out. I think that would be one of the big questions and stories that emerges through the course of 2025, namely how the consumer manages in the face of these elevated price levels.
Well, if companies are saying prices are going to go up, are they going to pass that along if tariffs come on and add to the cost of their materials?
Well, we've done surveys to ask this question as well, and what we've gotten in survey responses is yes, they're expecting to try to pass these through. The expectations about unit price costs going up is clear, but if you look at in our surveys about what they're expecting for price changes, the amount of price change they're expecting almost matches the cost change 1 for 1, which says a complete pass-through is the expectation. And then again, we'll have to see what happens in terms of whether consumers take that on board.
What are they telling you about the labor market and their plans for employment going forward?
Well, labor markets, they're still tight. Not as tight as they were 2 years ago, but what we hear from most businesses is that's not a source of worry for them. They feel like if they can get if they need workers, they'll be able to get them, and that wage pressures are not really outsized relative to where they were pre-pandemic. So folks are feeling pretty good about the prospects in terms of workers.
Border crossings are way down, and deportations are supposedly ramping up. What do you hear from the service industries about their abilities, or even construction, to find workers?
Well, we haven't been hearing this as an across-the-board thing, but we are hearing from particular sectors that there is a shortage that's starting to emerge in terms of work crews on housing construction sites and the like. We're just going to have to watch to see if that remains isolated or whether it becomes something that is more widespread, which then will have implications for the ability of the economy to meet the demand that's out there.
You were talking about consumer sentiment. What do you make of the rise in inflation expectations, which at least in the Michigan survey has been fairly dramatic?
Well, as you know, for many, many years, short-run inflation expectations have really matched where people are. And I think seeing the elevated prices, hearing the talk about the tariffs, and hear the idea that tariffs push up prices, I think has shaped people's expectations in the short run. It's the medium and the longer term that I'm trying to focus on much more. The reaction has been far less dramatic, but to the extent that that starts creeping up, that'll be something that I'll have to worry about.
Well, there was a lot of pearl clutching on Wall Street when Chairman Powell suggested that the impact of tariffs on inflation would be transitory. Would you use that characterization?
Well, I try not to use that word anymore. I will just say that. But I do think, look, we have to acknowledge that historically, when tariffs have played out, there's been a one-time jump in prices, and then the economy's returned to its usual trajectory, such that policy doesn't have to respond to it. For me, I think there is a question about whether that's going to happen this time. We've just gone through a period of elevated inflation, so it is very much on the consumer's mind. And I fear that they might be more sensitive to higher prices today than they have been in the past, but they might not, and we'll just have to see how that plays out.
Well, this whole question of seeing how it plays out, given how we're getting government by tweet and things change all the time, are you sort of foreclosed from acting preemptively? Are you going to be necessarily behind the curve?
I don't think we're going to be behind the curve, mainly because we know we're waiting. And so from my perspective, the longer you have to wait, that means your actions when you decide that it's clear where the economy is going are going to have to be larger than they would be otherwise. So I would say we don't want to it's not in our interest to move in one direction, find out that the economy is going in a different way, and then have to undo that. I'd much rather take the time, make sure that when we act, it's acting appropriately to where the economy is, and we can make sure that we stay close to our dual mandate objectives.
Now, you produce the GDP Now number from the Atlanta Fed. It's gotten a lot of publicity lately.
Yes, it has.
Not for its cheery news, but even adjusted for gold, it's sort of unchanged, which is a big drop from the growth rates we've seen. Do you think we're in the midst of a real slowdown, or was this just sort of a temporary dip at the beginning of the first quarter?
Well, we'll have to see. You know, GDP Now is a nowcast, so it takes data as it comes in through the course of the quarter. What I would say is the drop from the 2.2% down to anywhere from 0 to 0.5% is a sign that suite of data, that set of data that came in, is suggesting slowdown. We'll have to see what that looks like for the end of the quarter. I will say most businesses I'm talking to aren't reporting to me that they're seeing that kind of a slowdown, so we'll just have to wait and see what happens.
Well, if the economy slows a lot, which would suggest maybe that lower rates are needed, but inflation hasn't come down to 2%, and you want to have higher rates to quell inflation, if you have that sort of stagflation, which do you choose to act on?
Well, I'm not jumping to stagflation yet, so I'm just going to say that. But I've been saying for a long time, it is paramount that we get inflation back to our 2% target. That's the thing that I'm laser focused on. To the extent that the labor market and the economy does weaken, and we're not seeing that now, I'll have to manage that when that happens. But right now, it is let's get inflation back to 2%. That's one of the reasons why I've been comfortable keeping our policy in a restrictive stance, to make sure that we are trying to push that target and that measure to the number that we're trying to get it to.
If I could say this politely, one of the constants with the Fed's forecasts about inflation is that you keep pushing out the time frame for getting to 2%. What's keeping inflation sticky at this point, and what should we look for to see a sign that it is actually going to come down? Because PCE is expected to come in up.
So I'll just say, I haven't always been pushing it out. Yeah. Like the SCP in December, I actually pulled it forward a bit because the economy was progressing in a nice way. But what I would say is this: we know housing numbers have not come in as not normalized as fast as others have as well. We know the goods prices in the most recent period have risen a bit, and we're going to have to keep an eye on that. You know, I hear a lot about eggs and the like. And then we also know that service prices seem to have leveled off. So one of the questions that I have in my head is, are we seeing a fundamental change from the trends that we had been seeing over the last 2 years? That's not my baseline outlook, but it's a possibility, and it's one of the things that me and my team will be watching closely in the next 6 to 8 weeks.
Well, suppose inflation stays about where it is and remains sticky but doesn't go up. Is the Fed funds rate properly calibrated for that level of inflation?
Everyone I've talked to has given me information to suggest that it is. We will just have to see, with all the other pressures that are going on, whether we have to adjust and adapt based on new realities. So I think it will be an interesting question, the extent to which we do see upward pressure on prices as these tariffs come in, and it depends really on the suite of tariffs that we see. It'll be interesting to see how consumers take this on board. I think it'll be the intersection of multiple factors and forces that will determine really what level of policy we need to be at.
Well, do you think at this point you have a problem with monetary policy transmission, in the sense that you've been cutting rates since September, but market rates have basically stayed range-bound and haven't followed you down?
I don't think it's a transmission issue. I actually think it's a collective dynamic issue. As you know, the longer rates are a function of things other than just what we set our policy rate as, and there's been a lot of change in there. To the extent that there's uncertainty has gone up, you might expect rates to be stubborn on the high side. And so I look at it as a much more meta picture and really try to keep in mind that we don't control the whole economy. We control our policy rate, and that's what we have to stay focused on.
Let me go back to the beginning of our conversation and ask if you or the system have heard from the administration besides these tweets or random comments the president makes.
I've not heard anything, and you know, I will just keep reaching out, doing my job the way I have, and hopefully we will get to a place where the economy is stabilized and both of our mandates are at target.
Well, you and your colleagues talk a lot about the Fed having no role in fiscal policy. Do you think the administration should have any role in monetary policy? Well,
there's an opinion and then there's role. To me, I would say we are going to make our decision based on the task that we have at hand. We have an FOMC, we have 19 members, we have the Federal Reserve Act, which guides us in terms of doing that. And as long as that's the law of the land, that's what I'm going to focus on doing.
Do you find any issue with the Fed's credibility from all this outside chirping at you?
So I'll just say, from the time I've been in this job, folks have had comments on what the Fed should do. So that by in and of itself has not really been a factor. I do think that we have a lot of credibility, and I talk to lots of folks at almost at the end of almost every meeting. I get thanked for what we're doing as a collective, and to me, that's the true measure. When folks that are out there in the economy doing real things talk to me and provide feedback, the feedback has been appreciation about how we've approached the job and a desire for us to keep doing it.
One last question for our friends on the money market desks around Wall Street. You're cutting down on QT to $5 billion a month for treasuries. Do you anticipate ramping that up again, or is this basically it until you decide to stop?
So my preference would be to stay at this rate for a while until we stop. As you know, and as your friends on the desk know, it's not clear exactly what the threshold level of reserves is, at which point money markets might start to function less smoothly. I don't want to get to that level. We're closer to it now than we were a year ago. So for me, slowing down to make sure we don't go too far is fully appropriate.
Would you ever sell mortgages?
I would think about it. You know, the committee definitely has as a goal moving out of the mortgage-backed security space into treasuries. But now we just have to make sure that if we're going to go that route, and I'd say we've not had any conversations on that, we do it in a way that doesn't disrupt either the mortgage market or money markets more broadly.